The way I see it is like quality trumps quantity. Uh, it's kind of value investing philosophy anyway. So
Yeah, well, quite ironic, but yes,
yes.
it's
But yeah, I think this is sort of the core group anyway. These are the guys who come up to all the meetings anyway, and so maybe it'll be nice. Maybe each of us can introduce ourselves. If you could also for the UATX kids like add a little bit about what UATX is to you and like why you came to UATX because that's sort of an interesting part since we're a new university. So I can start. I'm from Santa Monica, California, originally, um, and also say interest in investing. I came to UATX because it was a school dedicated to open discourse and free flowing ideas of different perspectives. Uh, we're not shutting down people on Palestine or, super left or right. It's very open. And I came to value investing through necessity, mostly because I have sort of some inheritance from unfortunate family circumstances that I felt obligated to sort of protect. And so I read up as much as I could about value investing to do that. And I've, just been doing stuff on my own since. So next person.
Hi, I'm Thomas Olson. I'm from Wichita, Kansas. The reason I came to UATX is because they were offering this open discourse and this other idea of the easiest way to like not be in a 9 to 5 and start your own business would be at this university. So I thought it'd be a really good and fun time to just have all these debates, all these seminars, and these small classes that I'd really liked in high school. And then also it'd be the least likely place that I'll work a 9 to 5 and I'll start my own company. Oh, wait, I forgot. The reason I got into investing is because I had always heard that investing was like a way to compound your money when I was younger. And so I think since I was a sophomore in high school, I put like a little bit of money into my own accounts every year. And then before I used to just put money into the S&P, but then once I was shown this value investing club from Judah, I've been learning more.
Sorry. I'm Kyle. I'm from Austin, Texas. Um, I chose UATX because, I mean, like these guys, I was very interested in um, kind of this unique combination of a core in liberal arts education and really grounding yourself in foundational knowledge, and then combining that with sort of an entrepreneurial sort of experience where like a founding part of a founding university. So there's that aspect of like creating a school and helping the UATX administration create a kind of this new project, but also kind of to support my own entrepreneurial ambitions and maybe building a business one day, working with someone in the talent network to do that. I just thought that was a really unique and cool opportunity. As far as finance, I've been kind of exploring basically since I was like 12, more business finance. Um, Started a little bit of investing, mostly just index funds and bonds. Um, and then over the past couple of years, I've been working a lot in private markets. So I've done some venture capital and private equity. But mo like this year, I've kind of started focusing more on public markets, value investing, kind of looking at with the endowment fund how to pick good companies. And so very interested in kind of the opportunities that we have here.
Hey, good morning. I'm Eitan. I'm originally from Los Angeles. I chose UATX because I'm a STEM guy, like computer science, and I wanted to get the background in the liberal arts first. I thought it was very important to understand myself and understand the world before I actually made the big decision of what would I like to dedicate the next few years of my life to. So the philosophy, the history, the Western civilization at UATX is the reason I'm here. and the computer science also, of course, is important. And I was mainly attracted to the school by the other students who came to the summer events. And I noticed the high caliber, the interest, the curiosity, the lack of embarrassment in saying that you don't know anything and are ready to learn something new. I'm kind of new to investing. I got interested when I opened a Roth IRA like 2 years ago, and I was just very excited because I could take some risks with my investment because there's less tax I have to pay. And then I sort of left that account to grow on its own. And then this summer I spent my time at a venture capital firm. So I got a little experience in private markets. And now I'm with the UATX student endowment, which is public stuff. So I'm excited to learn more.
Oh, and I think there was somebody else joined. Oh, Christian, do you want to introduce yourself? You were saying why you came to UATX and maybe why you're into investing or what interests you.
There we go. That's the right button. So hi there. My name is Christian Chapotuk, and I'm from Spokane, Washington. Well, that's the closest town to me, anyways. But what really kind of got me down the path of investing and really kind of being along that kind of entrepreneurial track is, for one, the self-sustainability and freedom that I have, with the gains that come with investing, and of course, I mean, generational wealth, and whatnot. So, but also why I came to UATX is kind of to have a solid platform to where I can build and launch it into my future. That's probably the easiest way I can put it.
Okay. Gabriel or Mateo, probably next up.
Matt, you can go first if you like.
Hi, so good morning, first of all. I'm Matteo. I'm from Malta. Basically, my studies had focused on business management, and I got into the world of investing through Gabriel because I had some money which I had saved up, and Gabriel had introduced me to his ideas. And then later on, I started trying to learn a bit about investing, but I must admit that it's not my area of expertise. In fact, with regards to my role at Bilbel Capital, I'm not responsible for the investing part. I'm responsible for the marketing part of the fund and ensuring that our message reaches as many people as possible so that as a fund, we're also able to build an investing community. We don't look at it simply as a fund. Obviously, we would like people to join our fund and to invest in our fund, but one of our aims is also to reach out to organizations like yours and to also build networks with individuals who are interested in our philosophy and to build a strong investing community.
So my name is Gabriel. I I founded Bilbel Capital in 2022 with my own money, and over time my family invested too. So I started learning about investing when I was around 18. So when I was 18, I started learning maths and statistics at school, and I really liked the maths part, but I didn't really like the statistics part. And quickly I realized that the jobs I would get weren't the ones I wanted. So out of desperation, I went to look at what billionaires did, and one of them was Warren Buffett, and I saw that he invested in stocks. And at the time, I thought it was something that could be cool. And after a few months, I realized that it would be something I enjoy, and also that over a long enough period of time, I would learn enough such that I can become good at it. So I've been investing my own money and my family's money for 4 years. And now we are launching a fund in the US for myself and for accredited investors.
Got it. Okay. I first wanted to like you guys touched on it a little bit, but what is exactly Bilbel? What do they stand for? Why are they different from other funds? What's the message that Matteo talked about that you guys are forwarding?
Well, the goal of Bilbel Capital is to create knowledge, and as a byproduct, it would create wealth. So basically, all progress depends on knowledge because all physical transformations depend on two things, and that is having enough matter to create a physical transformation and having enough knowledge to know how to create that physical transformation. So basically, I spend a lot of time thinking about the best explanations of what is happening around us and what is happening in investing and the truth about companies, humans, and knowledge. And through that, I will share whatever I learn along the way and also implement what I learn in the fund.
Mhm.
So the fund till now is a family fund. I manage my money and my family's money. And in the next few weeks, we'll be opening a fund for accredited investors. Yeah.
Right. And could you sort of be specific on like knowledge as in investing strategies and or wisdom of life? Like could you specify what you mean by knowledge?
Yes, so there are different definitions of knowledge. I would say knowledge is an explanation of what is happening and how things we see are affected by things we don't see. And the value of an explanation depends on the ratio between the inputs it uses to explain and the outputs it does explain. So the greater the ratio, so the smaller the inputs and the higher the outputs, the more valuable that explanation is. So my goal is to create statements, which I call explanations. So these would be statements that explain cause and effect in a system, whether closed or unbounded.
Okay. Um and so okay. So what you're saying, actually we could probably turn this into a seminar because this is like already a few people, but so anybody can jump in. But what you mean um by knowledge as explaining, sorry, like I didn't really follow that part. The ratio of you're saying outputs of like quality of the explanation or quantity, like how are you measuring that ratio or the outputs and inputs?
Well, the outputs are things we see and the inputs are things we don't see. And the mapping between them is part of the explanation. So yeah, I mean, I'm not quite sure on your question exactly though. So,
So the
well,
input,
okay. So the most important implication of an explanation is that it is hard to vary. So David Deutsch talks about this, and what he means is that for an explanation to count as knowledge or to be useful, the amount of inputs used must be finite. So I can give an example. So let's say a stock goes up, and someone tells me that the goddess of water put up the stock. Now, the value of that explanation is zero. And the reason the value of that explanation is worth zero is that there are an infinite amount of different inputs I could have used instead of the goddess of water.
Mhm.
And the explanation would have stayed the same. So I could have said the glass of water instead of the goddess of water, and nothing would have changed. So that is an example of a bad explanation. And that is something that humans, including myself, default to quite often. But the importance I see is that I identify these and I try to correct the errors I have in my explanations. So a good explanation of why the stock went up would be that the stock is a part of a business. The business is very good. The management team is executing very well, and I bought the stock at 3 times earnings. And over time, people realized this value, they bought the stock, and the stock went up. So that is an example of a good explanation
Got it.
because I use the inputs such as a good company and a cheap price, and the output is that the stock went up, and I cannot change any of those inputs without collapsing the whole explanation.
Okay, I think that makes sense. So then
Yes.
if we're applying this to value investing, would you say that to have like the efficient market hypothesis is a bad explanation because you're using the same arbitrary placeholders in an explanation of, the stock went up because the market wanted it to and because like that's where it should be? Is that also coming from the same sort of bad explanation?
Yes, so the efficient market hypothesis is a bad explanation, and yes, so that is actually a good insight from your end. That's very nice. Yes, that's correct.
Okay. Okay, interesting. Anybody have questions on that before we dive into the questions that I was originally gonna ask? Okay. Um, First of all, why do you think somebody should go into the investing profession? And I wanted to elaborate on that a little bit. I met with Guy Spear a little while ago, who was sort of a friend of Buffett's. And there was this deep problem during a conversation I had with him of like, how do we explain people who leave the investing profession after, making all their money and then go straight into philanthropy as if there's almost a guilt or almost a regret of like opportunity costs. And so like what is the motivation to go the investing profession if it's so, common for people to want to leave so fast?
Well, the benefits I have is one of them, I can make money, which is a very obvious thing for most people. Another one is that I gained, and yeah, I gained very valuable friendships through this journey. And another one, which is also very important, is that I can test my theories of reality inside the stock market. And the stock market is basically a mechanism of feedback, and that feedback is over the long term quite accurate because people want to make money, and so people correct their errors to do so. So I don't feel any guilt for this, and I think guilt comes from the misunderstanding of investing. So investing is not a zero-sum game; it is a positive-sum game, just like all games that depend on knowledge and progress. And to be part of a positive-sum game and to make money along the way, I see no reason why to feel guilty.
So the knowledge that you're adding, let's say, to the stock market to arbitrage prices basically is creating the new value. Is that basically what you're saying?
Yes, so when I correct errors in the market, um, that is a valuable thing to have because you are taking money from places where it is not deserved to be, for that money to be, into places where it is more deserved. So a company that receives my money can can issue more shares at a reasonable price. They can have more power when it comes to borrowing money, and it also puts money in the hands of more capable people. So normally, a very good company has a very good management team, and a very good management team is better equipped to create value using the resources they have than others. And I am one of the many people that invests to do so.
hmm So I would challenge you why the ends of investing should be and why it's worthwhile to correct inefficiencies. Like, is the ends to make capitalism, more efficient and better working? And if so, why is that an important and worthwhile thing to do?
Yeah, I think it's worthwhile because uh, efficiency depends on skill. So if Elon Musk had no money, the world would be worse off because he's a very skilled human being. And for humanity, it makes sense for people to invest with him and to give him money so that he can create great products and great services. So giving money to a management team that deserves it is something very valuable.
Okay, one second. If somebody could butt in, I just got a notification I need to pay Zoom to keep the meeting going, so I'm gonna do that really quick. Sorry for the interruption.
I have a couple questions. Very generally, what sort of conditions allow you to put half of your assets in half or all of your assets into one stock?
Well, it depends on my net worth, my thesis of how much earning power I will have over time, and also the actual risk of the investment. So at the time I was invested in one stock, that was my entire net worth, but I also knew that over time I would have so much more earning power than what I put into the investment that even if it had to do very badly, I would be okay. So I think there are very rare cases in which it makes sense, and the higher your net worth relative to your earning power, the more careful one must be. But when there is enough understanding and enough mispricing, I realize that my mind defaults to an average position of something like 10 or 20%. But when I really think deeply about the risks, in some very rare cases, it actually makes sense to put much more money than you would think makes sense.
Okay.
Yeah, and the reason why I guess is just because there we go, unlimited minutes. Is because it's less risky because you're going to be making more money. That's really what you're saying, right? Like you put in a higher concentration, a heavier concentration, and like Munger says, like it's actually less risk because you'll make more money with it.
Yeah, yeah, kind of. So if you take it to the extreme, if my net worth was $1, it would make no sense to diversify because I can earn $1 in less than an hour. And so the risk of losing money is zero. Now, if my net worth is 1 million and my earning power is 100,000, then I have to be a bit more careful. So the risk must be exceptionally low for it to make sense to make the investment.
Oh. All right. The next question I wanted to ask. So Thomas was wondering about, being a businessman. I think a lot of us are into entrepreneurship. What is the difference in sort of character or skills that you need between an entrepreneur and an investor?
I think most of the skills are the same. It's just that they are applied differently. So a founder needs to understand how to run a business, and an investor needs to understand how a business is run. So the goal of a founder is to solve a problem with the help of people and tools. And his goal day to day is to find the largest constraint in the business and to focus only on it until he solves it. And after he solves it, there is another constraint and it keeps going forever. So that is the goal of the founder. The goal of the investor is to understand the business and the management team. And it requires deep understanding, but the founder also needs deep understanding. I would say most of the difference in skills is in managing and working with people. So an investor can invest without talking to anyone, just by understanding on his own. But a founder, sooner or later, would need help from other people, and he would need to be very effective at managing and setting standards for work.
I would challenge you on being able to invest without talking to anyone. I mean, first of all, you have people who are in a network that sort of check your ideas, like who are fellow investors. And then two, kind of like what, Lee Lu does or Phil Fisher, like they would go to people personally and then gauge, their character and skill by literally visiting them.
That's fair, and that can provide very useful information, but it is to a lesser extent than a founder. So a founder has to deal with people every day, and the investor has to deal with people only when he thinks that the information gained is useful. So I agree with you that the reality is that all skills are important, but it's just that some skills are more important for a founder than for an investor. So that was my argument. It's not that the value of talking to people is zero for an investor, is that it is less than for a founder.
Mhm.
But your insight was correct, yes.
Okay, makes sense. Okay. Um, and what do you think of Wall Street? So, I mean, that's a broad question, but we spoke already about market inefficiencies, and sort of, the way that the rest of the market, how Mr. Market, understands value versus what you understand it as. But could you sort of trace or paint a picture of Wall Street today specifically and how they react to events in the market versus you?
Well, I think that's a good question, but I don't think I'm very suited for the answer. So I focus on lowering the error in my judgment when looking at a company and at a stock. And that doesn't have anything to do with Wall Street. And whether Wall Street does the same or whether they do something different is not to my concern, because the only thing that matters is how accurate my judgment is. So I only focus on that. Now, what I can say is that Wall Street is built on certain incentives that can cloud judgment. So one of them would be that the way the hierarchy in a fund, in many funds work, is that there are incentives to show performance over a short time, and that might lead to irrational decisions. And also, the risk of doing something different is higher for an employee, because the gain from doing something different and doing that different thing well is quite low, but the loss might be that he actually loses his job. So what ends up happening is that many people default to owning the same stocks in similar funds, and that is a safe way for them to keep their job, but it's not a good way to make money. So
Mhm.
those are some incentives that cloud their judgment, which is understandable, but I am not operating in the same system, so I don't have the same constraints.
Okay. Anybody have questions so far on that? Okay. And then you mentioned in that answer this holding period issue. Uh, Something, if you look at statistics, show that the holding period in days on average has just plummeted in the past like 20 years. I think even longer. So what effect do you think that will have on Bilbel?
Well, I try to find alpha regardless of where it is. So if many people are looking at the next few quarters, and I have a good explanation as to where the business will be in, let's say, 2 or 3 years, and I see that relative to that explanation, the valuation is very low, then there is alpha to be gained. So most of my investments have depended on that. How much was that because of other people's short holding periods? I cannot know exactly, but I do know that it is a factor. But I also know that the reason why holding periods have shrunk over time are not always irrational. So what I can see is that as more tools were created, there is more leverage, so companies can change quicker. And if companies can change quicker, then the thesis on those companies will change as well. And if the thesis changes, then decisions must be made on a shorter time period as well.
Hmm.
So I see that happening. And also, the cost to switch between opportunities from the 1950s till now has gone down dramatically as well. So brokers historically have taken much higher commissions, and today the cost of buying and selling is extremely low. So switching opportunities is also a lower cost, which makes sense to switch when the right opportunity arises.
That makes sense. Okay. Um, okay, I have a specific stock question. What do you think of the market cap or the multipliers on Palantir and Nvidia specifically? Do you think that they're justified? Yeah,
Ah, I don't look at those stocks, but I guess I do know the valuation roughly. So I think Palantir is maybe at like 20 times
300.
the revenue, or maybe even more,
Yeah,
or like 400 times earnings.
yeah.
So no matter how good the company is, paying that much is such a huge risk, because the growth of knowledge is unpredictable, and you are looking so far ahead in the future that for you to make money, Palantir has to not only become the greatest company on earth, but must remain the greatest company on earth for maybe 50 years. And Uh, Depending on your net worth, if you have a net worth of 10 trillion, then you might be forced to invest in one of the top 10 companies in the world. But for someone like me, I can invest in much smaller companies, which are much more undervalued.
Mhm.
So Palantir is definitely overvalued. Nvidia, Nvidia is a hard one because it is much cheaper than Palantir. It's not cheap by any standard, but the capability of, well, the business and the management team is exceptional. So I think it might be the case that Nvidia does well as a stock over the next 20 years. But I would definitely not bet on it because it is not even close to one of my best ideas.
Does anybody want to push back against those? Uh, no, no takers, really? Somebody do devil's advocate for Palantir. I want to see. Aton, do you want to
That's a
go?
hard one, guys. That's a hard one. For Nvidia, yes.
It's a hard one. They had 4 billion in revenue over the last year, something like that, and they're trading at 300 something. So that, yeah, that is a
Ah,
crazy multiplier.
like
And defense
80 times
companies
revenue.
yeah,
Yeah, that's
defense companies tend to be overvalued as well. But um, I'm trying to think of like how I could make an argument based on their contracts, and they can sort of blow out these other like Google or Microsoft or Meta when it comes to surveillance um, surveillance contracts with the government. And that is very valuable information, collecting data on Americans, on foreigners as well. So I couldn't make like a quantitative argument, but because like a more qualitative on um, like basically there's minimal competition for them when it comes to these massive surveillance or software defense contracts. I could also make an argument that that the that the rule that you can't just grow incredibly every year forever doesn't really apply to them because Palantir is basically like a federation of startups. It's a bunch of on the consumer side, it's a bunch of mini companies that are all under the same umbrella. Um, we like their flat hierarchy is one example, but that the flat hierarchy comes from the fact that they're basically a bunch of startups acting on their own, and um, and that might allow for like continual unprecedented growth instead of more of like a tapering off and turning into a growth company or just like another incumbent. That's not to say that they're correctly valued, but that is to say that they should be at least like worth more. Like the future outlook for them should be better than other companies of the same size.
that's fair. That is very fair. So that is a good argument for why it should trade at a premium to many other companies, but not at a 50x premium. So yes, I agree.
Cool. Um, okay, and so Palantir is sort of inculcated in this culture of, private companies like Anduril, et cetera. And these guys, they maybe have or have no ambitions to go in the public market. And in either case, they would they would not want to go on the public market for, a long time, until they've gotten significant amount of private support. So what do you think is going on there? Like, do you think this is a new development? Is it for reasons of compliance costs? Why are people saying private longer?
Good question. I'm not quite sure, but it must be one of two things. One of them is they have access to capital, which is either cheaper or easier to get privately than publicly. And or money is much less of a constraint than it was a few years ago. So the more leverage a company has, the less money it needs, the less money is a constraint to growth. So I think both those two factors are at play. And for very large companies, it's mostly because they are already getting a lot of funding from from private companies, and the compliance costs and maybe the time to get to go public also is too high for them.
Mhm. Okay. And then I have a more specific question. So when you're looking at a company, uh, which type of statement do you think is most important? And you could say it's case by case, yes, but this is something that Buffett did say in the recent shareholder meeting that, for instance, balance sheets are undervalued. And I mean, if you read Graham, of course, like he's all about balance sheets, but the income statement today has a lot of sort of accounting profits and losses through, different ways that they can account for operating or non-operating costs and revenues. So which type of statement do you think is maybe the most important or the most authoritative?
So it depends on leverage. So when accounting standards were created, they were created for companies that had hard assets, and those hard assets created income, and the income was constrained by the hard assets. And it was very constrained because, let's say, a bakery could make 10,000 cakes a year, and if it was heavily optimized, it could make 12,000 cakes a year, but not 500,000 cakes a year. So basically, the asset was a very good proxy for how much earnings will come out of that asset. Now, as leverage increased, the possible outcomes that can come out of an asset has increased as well. So when we look at software, the replication cost of software for the most part is very low. And that means that a seemingly very small amount of money on the balance sheet that is allocated to software could be worth billions or trillions. And that is only possible because of the replication that is very low. So I would say balance sheets a very long time ago were a very good proxy for both the healthiness of assets and liabilities, and also a good proxy for what earnings to expect out of those assets. Today, depending on the leverage a company has, the balance sheet is of course important to know what they own and what they owe, but there must be so many adjustments made to the assets, since these assets can create a seemingly very large amount of value, that the cash flow statement, I think, became more valuable over time.
Hmm.
So cash flows are really cannot be played around with. So that's the amount of cash you received.
Hmm.
And income, so with software companies, income isn't normally a very good proxy because depreciation might not really exist. And so you need to add back depreciation. So many people use EBITDA.
Yep.
So it depends on leverage and which one of the three is most important. I think that might be the wrong question to ask because those three are dependent on each other. So they cannot exist without each other.
Hmm.
So I would say all are important, but to assess normalized earnings for companies with a lot of leverage, it would mainly be cash from operations and then some adjustment to maintenance capex.
Hmm. But would you also say, I mean, because of the fact that it's so hard to model how, some amount of assets would create all this value, do you think that's almost a risk in itself, like the unpredictability of looking at a software company's balance sheet?
Yes, for sure. So if I can't find a good explanation as to what will happen, at least it doesn't have to be accurate, but what needs to be accurate is the direction. So if I cannot even understand the direction of where it's going, then the risk will be too high for me to invest.
Hmm.
So I agree, yes, I
Hmm.
agree with you.
Yeah, because I think that's why, like, Buffett still, for instance, or Berkshire will still invest in sort of brick and mortar types or like kind of older business types. Um, okay, and then we talked about leverage. So do you think so? I mean, it sounds like from what you said, it's like a newer progression, a new development that we're taking on more leverage. Is that misunderstood or?
Sorry. By leverage, I meant the difference between inputs and outputs, not
Oh,
how much debt or debt a company has. So that's what I mean by leverage. So an example of leverage would be if I talk to someone, I gave value to one person. If I talk to 1 million people on the internet, I gave value to 1 million people. And that is a form of leverage because for the same amount of input, I got a larger output. So that's what I mean by leverage, not by debt.
Okay, understood. Um, okay. But I would still ask the same question then, just because it's on here. But you know, do you think that we're in a scenario now of of a very, I mean, it's kind of not really a yes or no question, but are we in a very serious debt situation, and how does that affect how Bilbel invests?
A serious situation in terms of the market being overvalued or
Um, in terms of regimes, in terms of the United States, the debt here, the debt overseas by country, sort of held by the public.
yeah, the debt situation is not great, to be honest. And that does affect companies. And in a very, if things had to go really badly, that would affect companies a lot. But since investing is a relative game, so I'm investing regardless of what I decide to do. And if that's the case, then the best way to invest for me would be to find the cheapest and best public companies in the world. So if I always find the cheapest and best, they will do best in bad situations and they will also do well in good situations. Now, things could go to very, very large extremes, and that must be accounted for as well. So if I see the US progressing in the wrong direction and actually seeing a catastrophic risk, then I might start looking at other markets more and maybe invest there. But at the moment, I don't see the catastrophic risk that much.
What would constitute a catastrophic risk for the United States?
I'm not sure, but the increasing amount of debt and interest payments and the lack of um, incentive to do something about it. So that is quite alarming. And if it keeps going like that, it is not sustainable.
Yeah, because I mean, I asked that question because Buffett raised that a lot in his last shareholder meeting that we need to be careful of companies that are degrading their fiat currencies at the rate of the United States, et cetera. That's why he's going more into Japan, for instance. So, I mean, is Bilbel going to be looking at more specific countries that are having, more stable currencies as a result?
Not much. So the undervaluation I'm trying to find is so high that it currency is a variable at play, but for the most part, it's not a big enough variable to consider. So if something is worth 10 times as much, then with the problems of currencies, it might be worth 6 times as much, but it's still a good investment nonetheless. So currencies are a risk when a person holds his wealth in currencies, and also for companies between the time they receive their revenue and the time they pay their costs, and also where they keep their cash. So the more devaluation there is, the more that company will get hurt. But apart from that, uh, the largest risks are inside the business. So if you're paying 20 times earnings for a good company, then a currency going against your favor can hurt you quite a lot. But if you're paying 2 times earnings, it it's likely not going to be the reason why you don't make money.
Mhm. Okay, so you've been sort of touching on the same idea of like creating such a big margin of safety that obviously macroeconomics don't need to play such a role. So is that something that's static? Do you have always a value-oriented approach? Or depending on the environment, will you switch to something more growth-oriented, like wonderful business, fair value?
Yeah, so by undervaluation, I don't mean a low price relative to current earnings. I mean a low price relative to all future earnings discounted. So that could be a company growing 1000% a year and me paying 50 times earnings. Or it could be a company that doesn't grow, but I pay 2 times earnings. So I don't categorize investments because in in the event of categorization, I always see that there is accuracy that is lost and there is error that's introduced. And so I am open to any investment as long as I can understand it and as long as the discrepancy between what I think the company is worth and what the price is,
Hmm.
I will act. So from time to time, it might be static companies at 2 times earnings. Sometimes I might find higher growing ones, but I'm not restrictive to any type of investment.
So then how do you determine at any given point where the discrepancy should be? So is it always 10x or then is it sometimes lower if there's just so many under overvalued things going on?
So I don't have a minimum, but I judge based on what other opportunities I have. So if I looked at every company on earth and the best idea I found was a 3x, then if I find 2 or 3x, again, I will buy it. So it is a question of opportunity cost. It's not that I have a bar that it has to meet. It's that I look at companies, I know my portfolio has a certain difference in price to value, and unless something is better than what I already own, I won't buy it. Now, if I had to start from fresh with zero positions and knowing no companies at all, then my hurdle rate would be, let's say, a 4x minimum. And then once I start building the portfolio, I will measure what I find based on what I have in the portfolio.
Hmm. Okay, I have one last question and then this is broader and then I want to open it to other questions that other people have. What is the role that AI plays in how you invest? Do you, for instance, see the value in outsourcing the grit of, paging through pamphlets of, va the value and insights and stuff that Buffett would talk about? Or, should we just depend on AI?
Well, AI can be very useful for the hard work, but has no use for creativity. So basically, the way AI works is that it looks at a certain set of answers and it tries to produce the optimized answer based on the problem set. Now, since we can attach very fast processing power and a lot of memory, it becomes very good at bounded games. So one of them would be chess, where maybe there are, I don't know, 10 trillion combinations, which for a human is a lot, but for an AI with a lot of memory and speed, is not that much. So when there is a bounded game, there is a finite set of outcomes, and it can sift through all of them until it finds the best one. So that also makes it very good at mapping ideas to others. So the amount of ideas that exist in the world are infinite, but the amount of ideas that are on the internet are finite. So AI is a very good tool for mapping one idea to another based on how much it thinks it could be useful. So I think as an initial screen, AI will eventually be a great screener. I think already with the technology we have today, we can do it. But to make the final call, it is not possible because creativity is not found from Chrome pressing solutions into one. It is found from allowing thoughts that are unbounded in nature, which till now only humans can do. But one day we might solve AGI, and when we solve AGI, then AGI can do everything that a human can do.
I find that a little bit vague because like why do you think that humans have access to this infinitude of thoughts? Like why are we, I mean, we are bounded, aren't we? We have finite biology.
Well, we are bounded by memory and speed, but not by understanding. David Deutsch did a lot of work on it, and he explained that there are no laws of physics that prevent the brain from understanding anything. And that means that the brain is a universal computer, so there is nothing that the brain cannot understand. So the only limits are computation, are speed and memory, but those can be added over time by creating new tools for ourselves.
Okay. Does anybody have anything to add?
I have some questions. Um, the first one, okay, so Warren Buffett just had the shareholder meeting in Omaha a few months ago. There were 40,000 people there. That's a lot of value investors, and value investing seems to be at least decently popular right now. And it seems that you're sort of relying on the fact that you're going to find something that maybe none or a few other people find. And with there being so many value investors, do you have to change your strategy? Is it really even a problem that other people are looking at the same stocks as you, and maybe you're just seeing something they aren't, even if they're using the same strategy?
No, that's not a problem. So there are many people looking at stocks, but yet there are so many undervalued companies and so many overvalued companies. And that will not change because of, well, I think one of the main reasons is the feedback loop. So even though there are many value investors, there are many investors that are not value investors. And there are many investors that operate with very little knowledge or no knowledge at all. And the amount of people that operate at that level are almost always more than the people that operate at a deep level of knowledge. So as long as that ratio uh, remains as it is, the opportunities will be there and there will be many, especially in small companies.
Right, but I think what Aton is almost saying is like the ratio needs to have some kind of lower bound, because if it doesn't, you'll have a problem um of increasingly minimized returns on the, input costs. Like for instance, if you're in value investor, it'll just take much, much more input to try to get and extract output.
Well, but you're assuming that value investing is systematic and it's like you can find them and everyone agrees that something is undervalued and so they buy it. But the reality is not that. So every human has errors and all human judgment has a certain level of error, although some have more usefulness than others because they are more truthful than others. So it might very well be that someone has an insight that no other person on earth has about a company. And it is the assumption that this this understanding is very easily ap- it's very easy to get is not correct. It is very rare for quite many companies. So there is there is no value that everyone can agree on a certain company and such that everything will be efficient. The knowledge set of people is so different that you might be competing against maybe one other person with a very similar knowledge set as yours, and that is inside the market with thousands and thousands of stocks.
Okay, then it seems like it's necessary for a value investor to have knowledge outside of investing. And I noticed this in venture capital, most people have like technical experience, or they know a lot about companies that they are focusing on, especially. So what is that for Bilbel Capital?
Well, I agree. The best investor is one that understands very deeply and very broadly, and both must be there. And each person will learn different things based on what he's interested in. For Bilbel Capital, it's mainly on philosophy outside of investing. So that is what interests me, and that's what I like to learn about. And so yes, under investing is very broad, and there is no real boundary to what investing is and what isn't. So if you dedicate yourself to understanding what's happening around you, and that includes physics, biology, and philosophy, and everything else, then you will have a knowledge set that is very unique and that you can apply where very few people have.
I had a question. So we were talking a little bit earlier about your ideas on well, there might not be macro implications that worry you when you're looking at investments. But different markets have different sort of opportunities in terms of undervaluation. Um, and I mean sectors within countries. What kind of do you have any like specific um, markets or sectors that you look to in particular for undervaluation?
I don't, but historically I found quite a few in real estate. So I look everywhere and I don't, it is a bottom, I think they call it a bottom-up approach. So basically, you sift through companies and then you find something that you like, and it just so happens that it is in a country and in an industry. But it's not that I pick a country and then I pick an industry. So the companies are found at the individual level. They are not found from dissecting the markets into different categories and then looking at once. Yeah. But there are different ways to find it. So as long as someone finds investments, then it works. It just so happens that I prefer to do it that way.
One thing that I, had on my mind, at least personally, like, is why go into the investing profession? I asked that, but I didn't quite get the question across correctly. Like, the opportunity cost is really STEM, like being able to apply the same kind of frameworks to building technologies. Why go into finance over STEM?
That's a valid question. Uh, the thing is that the word should doesn't make much sense in my life because it assumes that I know what the person wants and I know what the person is willing to do to get it. And I don't know neither of them. So the word should does not make much sense. And I realized that the word should has created a lot of suffering in my life. And after realizing that, I saw the value collapsing. So I don't think anyone should or should not get into the investing industry. I think it's a very good argument that you put that the opportunity cost for the progress of humanity might be better off if intelligent people go to STEM than in investing. And I think that might be true. So I think if someone is exceptional, he might be more useful to society if he works on building new things than if he works on buying things that already exist. But both are needed.
Right, right. Because as you said earlier on, like, in order to arbitrage, you're creating the value that can, not only be spent on issuing shares, but also building new technology.
Yes, yes. So that STEM researcher that then wants funding, he can one day go to an investor and an investor will help. So it's not that they compete against each other, they work together. So both are needed, both are important. Realistically, if one could create something exceptional, then I think it would be more beneficial to society if he actually creates it. But to each his own, and yes, that's what I have to say. I know it's not the answer maybe you're expecting, but yeah.
Mhm. Yeah, because there's also this element of the investor being able to have the leisure time to live a good life, and then that in itself models the good life to others. That's sort of the other argument that I thought of is like, you know, investing gives you an unprecedented amount of time to philosophize or run a family. And so, that in itself, at least today, is much more valuable, at least even just 50 years ago, for society as a whole.
Are you saying that people having free time would be more valuable to society as well? Or,
But spending it on worthwhile pursuits like having a family, for instance.
well, I don't treat any pursuit as worthwhile or not worthwhile. So if someone finds great joy or great um, depth in what he does, then I don't see any judgment in saying what makes more sense than others. So, yeah. Some investors might feel guilty for making a lot of money and not spending a lot of time, but in reality, people don't get compensated based on their work. They get compensated based on what they create. And investors create knowledge and transfer money from inefficient places to more efficient places. And people that create stuff solve a problem for someone, which is also very valuable.
Yeah. Okay. I think that concludes it, unless last thoughts, Thomas. Anything you want to add? No? Okay, well, this was good conversation. I'm glad that you took the time. I think I think we specifically learned a lot about, you know, the value investing approach in sort of a new light. I mean, I'm sure a lot of the things that you talk about have some resemblance to, Pabrai and Buffett, etc. But it's interesting always to see like how, the investor brings their own personality into how they invest. And I think there's something that is different about what Bilbel's doing. Um, so yeah, I think that's it.
Yeah, what maybe one last thing I'll add is that differentiation is not a goal. So the goal is to minimize errors. And if someone minimizes errors, then differentiation happens on its own. And then one might say that Warren Buffett and other great investors have similar thoughts. But the reason they have similar thoughts is that they corrected the errors in their judgment and they arrived to similar conclusions.
Mhm. Makes sense. Okay. All right. Well, that's it, guys.
Thank you.
Thank
All
you,
right,
Judah.
thank
Thank
you.
you. Thank you, everyone.
Right,
I hope
thank
it
you
was
very
worth
much.
it. And I appreciate it very much for you coming, especially on a Saturday.
All right, thank you guys.
All right.
Thank you, everyone. Good day. Thank
Thank
you.
you.
And Matteo, do you want me to just send you the recording and everything?
Yes, you could send it to me on LinkedIn, please, or
Got it.
via email.